I've charted everything that I've eaten since 2007. I am very motivated by that wiring that I have, and I call that the tides. What a person does any given day or the waves on top of the ocean, but there are these things that we do that are the tides, these things that compel us, etc. I think in my personal situation, I'm very much driven by the tides, and that's driven me towards entrepreneurship and intelligent risk taking, I guess would be the answer, is how I ended up here.
My friend Whitney Tilson describes my guest today as a stone cold moneymaker. I'll describe him as one of the most authentic people in finance. The two hedge funds he co-founded have raised more than $5 billion. He used to have one of the biggest short books on Wall Street. He graduated cum laude from Wharton, but he doesn't come from a country club background. He's got tattoos. He's got lots of them, in fact. And he owns some heavy metal music conglomerate, which maybe we can talk about later, that owns, I think, the biggest hard rock magazine in North America. He's a Wall Street guy in heavy metal, and he's a heavy metal guy on Wall Street. And he's also the founder of HX Research, a firm that brings institutional style research to individual investors. So we're going to talk about what makes him tick, difference between retail and individual investors, and hopefully some specific money-making ideas. Enrique Abeyta, stone cold moneymaker, welcome.
How are you? By the way, Whitney actually stole that from me. I was the one who I used that term, and then he turned it back around on me. So
got it. So it's your own weapon used against you. All right. Well, it's a good word. A good word. Who wouldn't want a stone cold moneymaker on their side? So thank you for joining. Let's do a super quick lightning round first. Just no need to think too much. Casual questions. Typical breakfast.
I eat the same thing over and over and over. I have an Oikos Pro yogurt, vanilla, 140 calories, great macros,
a lot of protein,
little bit of fat, mostly protein, yep. And I have a medium or large banana between 100 and 130 calories. I've charted everything that I've eaten since 2007. I have a spreadsheet where I take the time, what it is, the macros, etc. So I could give you actual data on what I've had for breakfast on average across the last 16 years.
I'm so glad I asked that question.
That'll start to tell you a lot about me right there. So this morning it was at 5:30 a.m. the Oikos Pro and a medium banana.
All right, best memory from the past year.
Oh, it's been a rough couple of years. I'm going to have to come back to you on that one, to be honest. I'm sure there's probably, there has been good stuff that's happened and a lot of like individual victories and stuff. You know what? The best memory is every moment I spend with my kids, dude.
Yeah.
Like I have 3 young kids. Children are a blessing. Like, I'll just tell you, why. Well, I'll give you one thing here. My wife is in Europe right now for a modeling thing. So the kids are actually over at my house and they sleep in my bed with me. And so I've got all 3 kids in bed with me. It's a king size bed.
Wow.
So every night in bed with my 3 young kids is
that's probably my son's 15. And after a point, like you're cool. And then suddenly you're not cool. At least hopefully you're always cool. At least for me,
I got 11, 7, and 3. So I still got it. So we'll see.
That's great. Your iTunes is stuck on one song over and over. What would that be?
Enema by Tool.
Huh. Finally, how would you like your kids to describe you to their kids?
Well, I mean, the best description of me, not what I want my kids to describe, is probably high intensity, low stress is actually something I use. I'm going to have to think about that one again. I think with my kids, I just want them to know that I really, really care and that I've got their back unconditionally and that we figure things out. I think that's probably a high level. Those are the talking points. Whatever the pithy statement will be, who knows? So,
well, I can certainly feel that care from this interview, and I think the audience can too, Enrique. So shifting to HX Research, what is it all about? And first, what does HX stand for?
Well, HX stands for, it's really hard to come up with a name. I created the firm a couple months ago when I left Stansberry, And it's hard to come up with a name. I was going to do ink research, which I really liked because I've got
Mhm.
all the tattoos. I own
Yep,
Inked
yep, yep.
magazine, and then I was going through ideas, and I love the idea, and this is where it gets really wonky. So our franchise is about taking institutional class, world class hedge fund research, but putting in language that real people can understand. So we are very technical in the back end and in our ideas, but in the expression of the ideas, the whole point is to not be technical, is to give you something that
Mhm.
that everyone can understand. So I'm about to get really technical though. I love the idea of dialectics where
Mhm.
you have an orthodoxy, which is the established order, and then there's a heterodoxy that goes against the orthodoxy. The two fight. Eventually, there's a revolution, and then you see a new. The heterodoxy becomes the orthodoxy. I think this is very much how human history has progressed, and so I love the idea of heterodoxies, heterodox research. So technically, HX stands for heterodox,
Mhm.
but no one in their right mind was going to get it's a mouthful and a half. Meanwhile, though, H and X look really good. They look really good on a t-shirt. It's easy
Yep.
to say. So that's basically how I came up with HX. It took me about a week. It was not easy to come up
That's a
with
good
that. But
story, though. It's
heterodox is actually what it stands for.
it,
But it's HX is the name of the firm.
that is
So
a much deeper origin story than I would have expected. Very impressive. You've
right,
actually, yeah, it
it's
is.
pretty intense.
You've kind of gotten to my next question a little bit too, which is it's kind of philosophical. But we've had 109 billion people have lived on this planet, depending on how you define a person. But only really a handful of mold breakers have really moved humanity forward, whether that's in politics, in religion, or in inventions or tech. So I've been impressed with people whose success it has not been because the tide just carried them there. So you're interesting, I think, in that regard. Now, this is not a therapy session, but like, what do you
Yeah.
think? What is it that makes you tick?
Oh, well, I mean, the first thing that made me tick was I was poor and I didn't want to be poor because that sucked. We had to sleep in our car for a couple nights. So I will tell you that poverty and the stress that it engenders is a tremendous motivator.
Yep.
That's number one. Number two, and this will get into a therapy session. I had a really tough childhood. A lot of stress, a lot of you know, the homelessness. My father was an alcoholic. There were all
Yep.
these things that
Yep.
happened. And it fundamentally actually rewired my brain. There's a great book called When the Body Keeps the Score, where it
Hmm.
talks about fight or flight. And they went and looked through people who come back from war and had PTSD, and they looked at their brain waves prior and their brain waves after going to war, and they noticed their brain waves had changed. And
Hmm.
then they did something where they went in and looked at those people, and they were able to get a lot of those people to get their brain waves back to what was considered somewhat normal. Normal is a funny term. But then they noticed that there was a group of people whose brain waves were the same going in and out of the war. They
Hmm.
ended up actually being their best soldiers by far, like all the
Huh.
guys who won all the medals, etc. But they were all people that came from childhoods of abuse and poverty. And
Hmm.
so what they figured out is that poverty and abuse, and I had lots of poverty, I didn't really have any abuse, or not
Hmm.
very much. How about that? That it rewires your brain. That I spent a time from the age of 5 to 20 living with this fight or flight, and it rewired my brain to be able to deal with high stress environments. So let's get back to what I said. I'm high intensity, low stress. When shit is going crazy, I'm super calm. It feels very comfortable. I actually struggle when things are going well and things are like, it's too quiet, kind of thing like that. But what motivates me? I'm big on biological psychology. I am very motivated by that wiring that I have, and I call that the tides. I think that the like what a person does any given day, or the waves on top of the ocean, but there are these things that we do that are the tides, these things that compel us, etc. I think in my personal situation, I'm very much driven by the tides, and that's driven me towards entrepreneurship and intelligent risk taking. I guess would be the answer. Is how I ended up here. So
Ah, love that answer. Love that answer, Enrique. Um, if okay, so taking the philosophy approach, but shifting over to investing philosophy now. If I were to try to scare someone away from active stock picking, I'd probably share three numbers. So the first is that 94% of large cap fund managers failed to beat the S&P 500 over any 20-year period per Dow Jones. The second one from Visual Capitalist, if you missed the best 1.9% of trading days over the past 20 years of the S&P 500, your returns would be 93% lower. And the next one is Hank Bessembinder, a professor at Arizona State University, found that just 4% of stocks made up basically all the gains in stocks, U.S. stocks, from 1926 until about 2000. The other 96% of stocks just matched treasuries. So in other words, beating the market is hard, and it seems to involve a small number of stocks and a small number of time periods that really deliver the goods. What's your, at least from those three numbers, and feel free to contest them.
I mean, those numbers are, you got to put it in context, and there's multiple ways to bake a cake, but continue and I'll address it.
Yeah, well, that's basically it. Like, what's the case then for active management?
Well, okay, there's a lot of things. I don't think there's a case for active management. I don't think you should put your money with almost any money manager out there. Most of them suck, and they suck for various institutional reasons. The vast majority of money management is not predicated on making money off the money they make for you. It's predicated on making money off the money that they manage. And so their very reason for existence, their very compensation is not driven by delivering you excess returns. It's driven by asset accumulation. Now, we could go out and argue that the more assets they get, the ones that get the better returns are going to gather more assets and all that. But, the first thing is, I think money management as a business is not fundamentally built to deliver excess returns, and therefore it doesn't. That's point number one. Point number two, I think that, and this almost gets back to the money management question. The rules to making money are actually pretty simple. And I want to go back to the ASU guy for a second. My methodology. So I basically break into two methodologies: trading and investing. Okay. And this is why we'll go to your timing thing here in a second. I believe that there are viable trading strategies in equities and options and some other assets that are short-term strategies, think, less than 90 days, where you can systematically take advantage of market volatility and create excess returns and absolute return, et cetera. The example would be blackjack and counting cards. Okay. Mm-hmm. In blackjack, if you don't count cards, you're going to lose by definition against the house. If you play perfect blackjack, you don't count cards, you got like a 0.5% spread between you. But if you count the cards, you can turn it into a winning equation. And I think that with trading, there are ways to count the cards and do that successfully. So over here is trading, and that's a very viable way. And we've got two newsletters: HX Trader that does equities, mm-hmm. HX Income that sells put options on those ideas that generates income. But then investing, to me, is, the whole problem with investing for most folks is the whole setup is just done wrong. You only need 20 stocks. Okay, that's all you need. They've proven that with diversification. The other thing is that every year there are hundreds of stocks that go up 100%, even in the worst markets. Sometimes there are 1,000 of them that go up 100%. But more importantly, when you take any rolling 3-year period, there absolutely are hundreds and hundreds of stocks that go up 100%. And I choose 100%. We'll take it across 3 years because that's a 30% IRR, double what the S&P 500 does. So what we do? We only focus on stocks that we think could go up 100% in a 3-year period. And we don't do anything else. We don't focus on anything else, because what the fundamental flaw is you only need 20 stocks. Okay. You want to find stocks that go up a lot. And then the beauty of this, let's get back to the ASU guy. You really want to try to find 10 baggers. And when you go through what 10 baggers have done, like the and I did a great post on this on Twitter a while back. I should resurface it. Actually, I'll tell you what, we for my daily, which is a free daily, which you can subscribe to at daily.hxresearch.net. I usually once or twice a week bring up stuff that I've written before. Next week, I'm going to bring this one up. But here's the point about 10 baggers. 10 baggers, 20 baggers, 100 baggers. They actually have a consistent profile. But what I really want you to understand about investing is this. You have 20 stocks. Let's just take 10 stocks. Let's do 10 stocks, okay? If I get a 10 bagger in those 10 stocks, okay, and 5 of the other stocks go bankrupt, 2 of the other stocks are flat, and 3 of them double, I still just made a 30% return with half the companies going bankrupt. And I'm betting you can do better than half your companies going bankrupt. But you got to find the 10 bagger. So to me, the whole setup is wrong. focus on 20 stocks, focus on stocks that can at least double, and really try to find 10 baggers, because 1, 2, 3, 4, 10 baggers across a 10-year period, as long as you manage your risk right on the other side, and you're going to blow away the S&P 500. So, but I just think they're playing the wrong game, to be honest.
Yeah, it's interesting. So it sounds like you would never buy a Berkshire Hathaway if you got 20 punch card slots, right? Because it's maybe a little bit better than the S&P if it goes well.
What's your goal, right? So
Yeah.
what's the strategy? It's not that I would never buy Berkshire Hathaway. First off, we trade the bejesus out of Berkshire Hathaway. Second is people have different. I know I kind of hate this answer, like, what's your goal? It'll depend what you do. Look, if you're asking me to outperform the S&P 500 on a risk-adjusted basis, no, Berkshire Hathaway doesn't by definition strike me as something that would play a part of that portfolio. If you're asking me to preserve capital in down markets and grind out returns and do a certain absolute return, then Berkshire Hathaway fits. But if you want to outperform, because that was your question. Your question was actually outperformance and active management. If you want to outperform, you need to find stocks that are going to double, triple, 10 bag, and you need to focus on that, because that's the only way to outperform in longer term, long only strategies.
So let me double click on that then, because what you're saying makes sense logically. There's a histogram, right? And the big winners kind of more than carry the loser's weight. It's like in venture capital, like in private equity, maybe the histogram is not as spread out. In public markets, a little bit, the real duds are out, but you still got a lot of duds. How do you find those that small group of stocks that's going to pull all the rest?
I mean, I'll give you, it's actually easier than you think to a certain extent. Stock performance, I could go on a lot of subjects here. Stocks are not companies. While when you own the stock, you technically own the company, but it's not like you and I have ever seen a dime of Amazon's cash flow. It doesn't pay a dividend. It doesn't buy back stock. So to a certain extent, stocks are actually NFTs. They're digital certificates that represent this legal ownership. But really, stocks are worth whatever anyone's willing to pay for it, with the proviso that if they go bankrupt, they're worth zero. If they get bought out, they're worth whatever someone buys them out for. And in between, they can futz with the supply and demand via buybacks, dividends, etc. But I'm going to give you a rule of physics that works with all stocks. You give me a company that's earning $1, and that company grows earnings to $10. That stock is going up. May go up a little, may go up a lot, may go up more than 10 times, may go up less than 10 times, may go up now, may go up later. You grow earnings from $1 to 10, your stock's going up. And now you'd say, well, oh, that's growth investing. Oh, well, what about everything else? Well, no, cyclicals go from $1 to 10. Value companies go from $1 to 10. Coca-Cola didn't make Warren Buffett the money because he bought it cheap. It made him the money because they went from doing 300 million of EBIT to doing 3 billion of EBIT. So identify companies that can grow earnings like that. Now, what companies can grow earnings like that? Well, generally, you're going to want to look for something in the total addressable market. So I did another podcast or a presentation earlier this week, and I talked about Match.com. I love Match.com as an example of a TAM or total addressable market. The leader in dating sites. There are 1 billion people on this planet that want to hook up and that are ostensibly available. There's probably 5 billion that want to hook up.
Ostensibly.
We're talking about it. We'll go. And actually, to be honest, the number is probably closer to 2 or 3 billion. But let's just take 1 billion. There's 1 billion people that are online that have a reasonable amount of money that want to hook up. And Match right now, I think, has 26 million or 23 million. I haven't checked the numbers recently, paid subscribers. So I'm not saying that Match is going to 1 billion. But I'm saying from 23 million, they could go to 30, they could go to 50, they could go 100. That's an example of a huge TAM that they can grow into and all that. So to me, you want to find 10 baggers, find companies that are going to grow revenue and earnings tenfold.
Got it. Love that. One barnacle thing I want to put on to squeeze a little bit more on that, because investing is a social science, right? So I could run out and find some screen and say, okay, these companies I think are looking at the biggest TAMs, the fastest revenue growth. Great. But if everyone else has those same expectations or even higher, like if, I don't know, NVIDIA or something, I might not make as much money, right? If that's priced in. So do you think, is it just numerical TAM in your mind, or do you kind of weight the value?
I will tell you this. If you give me a company that is earning $1 today, and that company in 3 or 4 years is going to earn $10, and it's in the numbers and everyone agrees on it, and they then deliver that $10, that stock is going up and will beat the market. Still going up. Now, there's a big if there. do they deliver that $10, right? And NVIDIA is a perfect example when we talk about expectations. Why is NVIDIA up so much? Okay, we've been talking a lot about NVIDIA the last 2 weeks. NVIDIA is up because of earnings. A year ago, they were expected to do $6 in 2024. Now they're expected to do $24. Guess that's 400% growth in the estimate for 2024. Guess how much NVIDIA stock is up in the last year? 400%. It goes right in line with earnings. So this kind of gets to the question of NVIDIA, which I wrote about earlier this week in my first two notes this week. If you think NVIDIA is going to go up 4 times again, you got to believe earnings go from 24 to 100. Okay, I don't think it's going to happen in a year though, because we're getting a lot of big numbers. Not to mention you're taking a $2 trillion company,
$2 trillion market cap.
Yeah. So we're very focused on. I guess I'll come back to this thing. Let's go back to match. We'll finish off with this. I think you need to identify TAMs that can justify the earnings growth. But then for our 20, because life is too short, we like to find companies that are executing. And Match is a perfect example. Match has been missing numbers left, right, and center, and it's been a terrible stock. And I don't really think you should own Match right now, okay? And, so you can ask yourself, why is it missing numbers? There could be 2 reasons, right? Number one, is it missing numbers because we're wrong? Is Meta getting into the market? Have we saturated the market? Is the technology wrong? No, and no. Okay, none of that's happening. I could go through. We could spend a whole podcast on Match, but they're missing numbers because they just don't have the sound of the music. They're not executing, and ultimately, management teams are like baseball teams or football teams. You could have all the talent in the world, but if your coaching's off and the team's not gelling, you're going to suck. It doesn't matter what your opportunity is, how good the company is. So we try to find big TAMs, big growth that are also executing, that are beating numbers and seeing rising expectations. That's really the equation, for outperformance, in our opinion. And by the way, screw our opinion. That's mathematically factual. Okay, those are the stocks that outperform.
Yeah. Well, if you do that, you can't go wrong. If that happens according to the plan. True. What is your biggest weakness as an investor?
Oh, I have a very high tolerance for pain. It's probably my biggest weakness as a human being, to be honest. I don't give up easily enough. As an investor, I'd have to think about it. I'm pretty systematic. At this point, I'm 30 years in, man. I got to process. I'll tell you, I'll tell you what happens with this. A lot of my process in trading has versions of trend following in it. And when the primary trend moves from a uptrend to a downtrend, as it did in late 21, early 22, I'm subject to periods of loss that involve a transition. And I need to identify that and manage that transition. But in the beginning of the period, I still need to stick to my process. So I'm almost guaranteed to lose money and underperform. But here's the thing. I wouldn't trade that. That's a weakness, but it's not, it's a systematic weakness that's built into my model. And across the population of decisions, I still come out with a super massive NPV. And if I went in and broke that equation and didn't support those positions on the way down initially, my NPV is massively negative because I break the actual process. So, look, there's 2 types of weaknesses, right? There's weaknesses that are systematic that you need to fix, but then there's weaknesses that are, any system, any process that you have, you're going to go through certain periods of the cycle, certain situations where you're going to lose money. That's probably ours. So that would be what I would say in terms of our strategies.
Which is not so much an overall weakness; it's a known weakness inside of a system. No system is perfect.
And by the way, so that's for my trading. For my long-term investing, I'll give you a weakness. If you buy stocks that are going to go up 100 to 1,000%, they're going to get cut in half at some point. You can't have one without the other. So that is the challenge, is that, and with HX Legacy, which is our long-term strategy, what we do is we look for a 3-to-1 risk reward. Okay. So if I think a stock can go up 100%, I want a minimum, or I kind of want a normalized downside to be about 30%. So we're not full on YOLO with the names. But you know what? We're going to have, I will have 1 or 2 or 3 bankruptcies across the course of a cycle in my long only stuff. just because I'm not playing for 10, 15% returns. Now, that's that strategy. We have another strategy we'll launch at some point called HX Protect, which is kind of the opposite to a certain extent, which HX Protect is the world's ending. How do you protect your money? Yet, if the world doesn't end, how can you still grind out some returns? Again, these are the different things. But if we're talking about outperformance, these are the weaknesses. I know what the weaknesses are, and you just kind of have to live through them. HX Protect, its weakness would be it's going to underperform in a raging bull market. So
you're buying put options maybe in that case?
No, HX Protect will be just about the stock picking. It'll be a little bit more income oriented. It's just the type of stock that you're buying or kind of opportunity that you're looking at.
Got it. I'm just recalling based on what you said a minute ago, Amazon at one point was down 94%, I think, in like late 90s or early 2000, and then it rose. I don't know what the number is, 70,000% or some crazy number, right?
NVIDIA was down 50 or 60% 2 years ago. Like, you can't have stocks that are 10 baggers without them getting cut in half. Tesla's been cut in half 3 times, 4 times, 5 times. I don't know off the top of my head. So again, what are you playing for? If you don't want stocks that go up tenfold, then don't buy a stock that you could get cut in half. Now, there's plenty of stocks that get cut in half that don't go up tenfold. But my point is you can't have one without the other.
Yep. Totally separate buzzwords that I'm going to ask you about in the same question. So take them one at a time. But what do you think of crypto, and what do you think of ESG?
Look, I think for crypto, I'll take it 2 ways. I think that crypto specifically Bitcoin and Ethereum as digital stores of value, I think have a tremendous future. I've been very constructive on Bitcoin. I kind of think all stocks are worth nothing because, again, they're just kind of NFTs of companies. Gold is worth nothing. It has no industrial use. We've got 300 years of industrial use gold inventory, but we all decided gold's worth something. We agreed on that for 5,000 years. So at this point, the dollar, the US dollar is worth nothing. Yet we all agree it's worth something. Enough people agree it's worth something. It's worth something. Art, baseball cards, etc. Yep. Bitcoin is digital gold. And, what I like about Bitcoin is they're not going to make any more, and the world's getting more digital, not less digital. And so I think the demand, and when you look at how Bitcoin is being used in international markets, I think it's tip of the iceberg. So I think crypto as a store of value for select cryptocurrencies has a tremendous future. Blockchain as a technology for authentication, other categories, and how that interplays with other cryptocurrencies, I also think has a big future. I think it's just a little bit more complicated. But I've been on record. Again, on record, I said buy Bitcoin. I like Bitcoin. Great. Me and like 10,000 other people. Doesn't matter. I still think it's going up, and I think it's going to new highs. It may take a breather. It may get cut in half again from here. So that's crypto. ESG is the most ridiculous thing I've ever heard of. I mean, I think that when we go back, and I'm actually going to go, I'm not going political, but I'm going to discuss climate change here for a second, but it'll go straight into ESG. The idea that climate change is man-influenced or man-made and is actually happening, I'm fine with it. I can get behind it. There's a lot of data. There's data both ways, but let's just go with it's true. Okay, climate change is real, etc. The ideas that we're using to try to solve it are the most ludicrous things I've ever heard of. The carbon credits. Carbon credits, literally, what could happen tomorrow? The governments all wake up and decide, yeah, this whole carbon credit thing, we decided it's not really working. They're all worth zero. Because carbon credits have no value, right? It's not like aluminum, which I can use to make a car. It's not like corn, which I can use to feed someone. So the whole ESG thing, I think the biggest scam that's actually been perpetuated on humanity and the middle class and the poor classes in the last 30 years is the reallocation of wealth that's happened because of ESG. Meaning we've created this whole bureaucracy, this whole system of all this money that is basically a massive tax on the actual people generating the economic production, and it has no benefit because it's not going to work. China's still going to do what China's going to do. India's going to do what they're going to do. And this is my whole thing, is I feel that like climate change, the prevent part of climate change ended sometime around 1975. We've been in prepare. All that money should be going to moving cities higher, further inland, et cetera. So I think when we look back at ESG, it will be considered one of the greatest intentional, unintentional scams in human history, and reallocation of wealth from economic producing folks to the economic upper class. And it's nuts. It's absolutely crazy. So how's
Very
that for an
interesting.
answer?
Yeah, I love it. Okay, shifting gears again. Can you share any investment ideas, stocks, sectors, whatever, on your radar now?
Well, we don't give away free ideas. I am getting ready next week to give away a free longer term idea. It's a really interesting juxtaposition. It's a stock no one's ever heard of. It was a company that came out of bankruptcy. It trades on the pink sheets. There's
Hmm.
not a lot of good visibility in it. It's very off the run. And yet the company owns one of the rarest assets on earth, one of the most valuable assets on earth, an asset that, by the way, when we talk about ESG, is as perfectly positioned as anything that is out there in terms of ESG, a real beneficiary of the real solutions to climate change. I love this idea. It's classic to like my style. I got it through friends who were involved in the bankruptcy, et cetera. We're going to publish that late next week. We're going to publish another free idea. Usually I'll have two free ideas out there, one trading and one investing. That's the investing one. I'm not going to tell you what it is, but on the podcast I did earlier this week, I talked about Adobe as a trading idea.
Mhm.
And, Adobe's a perfect example of what we look for. The company's a goddamn winner. They've grown earnings tenfold in the last decade. The stock's gone up 15-fold. They've got huge competitive moats, massive returns on capital. They beat numbers. The company has beat of the last 40 quarters, 39 of the 40 quarters. And the stock looks like this. People acknowledge this, and it's growing and doing all this great stuff. And 2 weeks ago, Adobe sold off because of ChatGPT Sora, which is this video engine. And I mean, the stock was down 15%. Okay. So why was the stock down 15%? Well, I got to tell you, ultimately, it's not because of Sora. Sora is not available, doesn't really work yet. And even if Sora becomes available, Adobe can go out and just use Sora in its stuff. Like, the fundamental case isn't there. Adobe was down 15% because the markets had a big run. The stock was overbought. Everything's gotten very frothy. So it didn't take very much when you're kind of at the top of the mountain to tip you over and have you slide down the mountain pretty darn quick. So Adobe is a perfect example of what we look for in our trading strategies. We're looking for winner companies that have well-established uptrends that then get statistically oversold, and we buy that dip after it begins to recover. Okay, so we recommended selling put options in Adobe. Those put options, I'm pulling up my Bloomberg right here. I told you I might look over at my screen. Those put options, since we recommended them 10 days ago, are for our readers up 60% on those. And, we're going to put a formal recommendation out on the stock. I think the stock's probably got another 5-10% upside from here. But that'll give you an example of trading and investing. By the way, is Adobe a great long-term buy? Probably. Do I think Adobe's going to go up tenfold from here? It's tougher for me to get around that. But it's a great company. But those are perfect. And it just so happens, again, sign up to daily.hxresearch.net. Next week for the free ideas that we're going to publish, we'll actually put it to our whole free list. So it'll be out there for people to read the full report.
That's great. That's great. I was going to say, if someone listening to this likes what you're saying, I'm guessing a lot of people do, where would you send that person? It sounds like daily.hxresearch.net. And we'll put this on the show notes under the video. Is the single best place?
Yeah. And you can also follow me at Enrique Abeyta, one word, ENRIQUE, ABEYTA on Twitter. There's also HX_research on Twitter. But yeah, daily.hxresearch.net is the best place to it's the entry point. It's our free daily. Our free daily, I think, is awesome. I write it, so of course I'm going to say that, but I think it's really valuable. And we don't crush people with a ton of emails. We don't send almost any marketing emails. Like it's a very different vibe than a lot of other stuff that's out there.
Excellent. Well, Enrique, this has been really one of my favorite interviews ever. It's been very informative, and I'm sure a lot of people liked it as well. I'm guarantee you that. So, Enrique Abeyta, thank you so much for speaking with us today. And thanks to you guys, as always, for watching us at home.